Well, welcome everyone to the registered fund panel of the portion of the compliance conference this year. I'm going to start with just introducing our panelists, and then I'm going to provide a little context about what we're going to discuss today, and then we'll dive right in. So on the far right is Chris Jackson, a Senior Vice President and General Counsel at Calamos Investments. In the middle, we have Naseem Nixon. She's a Vice President and Associate Counsel at Capital Group. And on the left here, Brian Johnson, who I'm sure many of you know. He's an Assistant Director in the SEC's Division of Investment Management and in rulemaking. I'm Nathan Briggs, a partner in the Asset Management Group at Ropes and Gray here in the Washington, D.C. office. So, just a little context about how we're going to approach this panel. This is a incredible year for registered fund developments, including both regulatory developments, but also just market developments. So it's a tough year to do an hour panel on registered fund development. So we're going to approach this maybe a little bit differently than similar panels in the past. We're going to assume some general knowledge of many of the rules and developments that we're going to talk about. And we've also included lengthy summaries in your materials that go into great detail about many of these developments. So we're going to be skipping over a lot of the kind of description of the rules, and instead I'll be asking the panelists questions, and we'll hopefully have discussion around maybe some of the more interesting or meatier parts of the rules. So with that said, I will go ahead and dive right in. And we've broken this up into kind of the first half is recent developments and the second half is looking ahead. So we will start with the valuation rule. I think as many as you know, it was adopted on December 3rd. It goes into effect on March 8th, and it has a compliance date of September 8th, 2022. So Chris, I'm going to start with you with the first question. So, many firms, practitioners are of the view that, generally speaking, the valuation rule is going to largely consist of formalizing many of SHOP's current practices, particularly around reporting, utilizing and overseeing pricing services, and evaluating pricing methodologies. That said, there are certainly going to be changes. So in your view, what are some of the more significant ways that you see the rule affecting current practices?
Thanks, Nathan. I've tried to break this out into a mnemonic called PAT R2 for process, approach, testing, reporting, and record keeping. Let me touch on those briefly from a perspective where I think there's a little added to what we're currently doing. In terms of process, we are required to do an assessment and management of risks. We need to identify and approve risks, including conflicts of interest. The proposed release provided some examples of the types of risks that we should be taking into account, like types of investments held by the fund and the characteristics of same, the potential market or sector shocks or dislocations, and other types of disruptions that may affect evaluation, designees, or third parties' ability to operate, and the risk that the methods for determining and calculating fair value are inappropriate, or that such methods are not being applied consistently or correctly. Those are some examples. There are others, and you want to take a look at the proposed rule to take a look. Let me go to the next one, approach. There's more granularity. The need to specify key inputs and assumptions specific to each asset class or portfolio holding. The need to periodically review the appropriateness and accuracy of the methodologies and monitoring circumstances that may necessitate the use of fair value. Trust me, the SEC is going to be looking for documentation as to the fact that we have done this. And then in terms of approach, also look at responsibilities. The need to specify titles and functions of responsible persons. And we need to reasonably segregate portfolio management from the function of fair valuation. Well, for a lot of us, that's going to be a twist on what we currently do. Let me go to the next, testing. The need to test the appropriateness and accuracy of the fair value methodologies that have been selected and focus on the testing methods. There's a minimum frequency with which testing methods are to be used. As compliance personnel, we're used to periodic and transactional forensic testing and developing a lot of our own tests. Not that we can't do that here, but the commission is leading us more by the hand, if you will, and making sure that we dot I's, cross T's. Let me move to the next. My first R, reporting. There is a layering effect. Well, what do I mean? The types of reporting, the quarterly, okay, need to report any material changes to risks, approved valuation methods and pricing services, monitoring or evaluations. We've got annual reporting requirements where we're going to report out on the summary of all testing results, evaluate adequacy of valuation resources and changes in persons responsible. Query, how does that fit into your 38A1 annual review? Are you going to combine them? Are you going to separate it out? Is it yet an additional set of reporting that you're going to have to do? And then finally, there's prompt reporting. You got to report any material deficiency or error within 5 business days, but the board, a standby, could shorten that time period. And so we've got to make sure we include any material errors in the calculation of NAV in those reports. And then my last one, record keeping. The new Rule 31A4, you know the rule. It's 6 years, but easily accessible for the first 2. You're going to have to keep documentation of fair value securities and all communications to the fund board as part of Rule 2A5. Nathan, that's it in a nutshell from my perspective.
Yeah, thank you. I think you made a great point about the SEC. In light of all these developments, the SEC is certainly in exams going to be looking for how the documentation around these new rules is set forth. I think that's a really good point. Turning to another aspect of the rule, I think a more controversial aspect. Naseem, the adopting release for the first time provides a definition of when a market quotation is readily available. I think that was a surprise to many in the industry, seeing that. And what's the surprise is that is the discussion in the adopting release around 17A7 cross trades and readily available market quotation in that context. Do you want to comment on that?
Sure. Yeah, it's true that the valuation rule does create this new definition of readily available market quotations. And what was a surprise to us was that it would apply in all contexts under the 40 Act, including cross trades that are governed by Rule 17A7. So pretty much in short, the valuation rule states that a market quotation is readily available for a security only when it's a quoted price, unadjusted, in active markets, which is pretty much consistent with level 1 securities under GAAP. So Rule 17A7 requires the price of cross-traded securities to be readily available. So in effect, with this new definition, only level 1 securities could be cross-traded under this new framework. So with most fixed income securities classified as level 2 or level 3, this could really eliminate the ability to cross-trade most fixed income securities if this framework takes effect. So in my view, this would have a devastating outcome for investors in many fund complexes, as well as our markets. For example, cross trades within a fund complex benefit shareholders by avoiding brokerage costs. When you have to buy and sell on the open market, it incurs almost duplicate brokerage charges for both sides of the investing public within your fund complex. And then there's another example is just the loss of investment opportunities once securities are traded away. For fixed income, the maturity rates, it's valuable to hold these securities. And so when there is a redemption or a need to sell a security, it's great when a fund complex is able to keep that security within the complex and continue to benefit shareholders and take advantage of those maturity rates. And there's also the loss of liquidity tools in volatile markets. And we've seen how the resilience of some of our funds through cross trading during this same time last year, during all of that market volatility. And so perhaps Brian can talk more about this, but the SEC did note in the adopting release that the staff is considering amendments to Rule 17A7, and fund shops like ours are fully support modernizing the rule and keeping the rule focused on the best interest of investors and the principles of fairness, and making sure that's evident in any kind of modernized rule. That also takes into account new developments in technology and the ways in which we're able to protect shareholders and take advantage of the benefits of cross trading. But I think one of the challenges is that the valuation rule, as you noted, Nathan, is it's effective March 8th, so it's coming up in a few days, and then the compliance date is in September of 2022. But in the meantime, for funds that cross trade fixed income securities, we, at least my understanding under the rules, that we can't formally implement the new valuation rule requirements without implementing everything that's a part of the valuation rule, which includes this new definition of readily available market quotes, which again has an influence on our cross trading programs. So, in other words, I think the ambiguity with the Rule 17A7 has created a situation where fund managers are actually, in some ways, disincentivized to comply with Rule 2A5 early, given the effects on cross trading practices. And I think that kind of makes an odd result from a policy perspective. So again, I know our shop and many others are ready and engaged on the proposal or the recommendations that could come about with modernizing 17A7. I do think it would be helpful for the SEC to give some additional relief or guidance on this front, perhaps through an FAQ, so that there's more of a written assurance to sponsors, to fund sponsors, that the SEC isn't looking to end fixed income trading before amending Rule 17A7, and that sponsors like ourselves can really focus on engaging with the SEC to really modernize the rule and make it better.
SEC engagement. When this came out, I think the reaction for many of us was, and we called up a number of folks in the staff and said, "Well, did you mean to have these implications with fixed income securities? That is that what you really meant?" And the response typically was, "Yeah, we kind of what we said in the release." I don't know, Brian, do you have any background on the discussion of the adoption release or this aspect?
Yeah, I'm certainly glad to speak to this. Before I do, let me just give the standard disclaimer that that folks in my position always do give, which is that the views I'll express are my own and not necessarily those of the commission or my colleagues on the staff. So, with that out of the way, I can certainly offer a few thoughts here. I mean, the first is, the commission defined when a market quotation is readily available in Rule 2A5, because that was necessary for that rule. I mean, that is the predicate question about whether a security is fair valued or it's given its market value. So in the first instance, it wasn't, at least my way I would think about it, it wasn't that it was the intent of the commission, the rulemaking team, to speak to 17A7. That wasn't the objective that the commission set out with, that we set out with either. But the commission did need to define that term, or felt the need to define that term for Rule 285. And that's against the backdrop of, the commission has always stated that the term readily available market quotations in Rule 17A7 is intended to have the same meaning as in the valuation provisions in the 40 Act. That's the direction of the causality. And so what the commission did, I would say, is just observe this interaction and said, look, we have defined this term Rule 285. We believe it's necessary to do so. That term appears also in Rule 17A7. And so I think the commission was just, was acknowledging that flow through implication. But as you all have noted, but also said, but 17A7 also was on the rulemaking agenda, and had been, before the valuation rule, and also welcomed in that release, welcomed public input on Rule 17A7. And I can say from my perspective as well that there have been outreach efforts in connection with Rule 17A7 that predated the valuation rule. Those have been productive. I expect that will continue, and our virtual door here is open about 17A7, and that is a project that folks, that's a project that folks are working on. So that, so I guess my 2 cents are, this rulemaking 2A5 was about valuation, and it had this implication, but the commission also is looking with open mind at Rule 17A7 as well.
Oh. Thank you, Brian, and thank you all. We have a question on the valuation rule before we move over to derivatives. The question is for advisors with separate CCOs for their registered funds. What implications do you see the rule having for valuation practices for their SMA accounts or non-registered fund accounts, if any? I'd be curious to anyone's thoughts. I mean, I guess my view is that while the rule may not specifically apply to SMAs and other accounts, I think it's very likely that if you have a significant registered fund component of your business, you're going to adopt valuation practices that are pretty much practiced across the board. Maybe there'll be some tweaking around some of the documentation with respect to the client, but I don't see large differences once you institute it. But I would, Chris or Naseem, I'd love to hear your thoughts.
Yeah, I'll just jump in and say I agree with you. I think from our complex's viewpoint, operational consistencies really help with efficiencies, and it's hard for our teams that wear dual hats, whether they're servicing institutional contracts or our registered fund contracts, to have varied policies and procedures. So I do think that this will just become the new best practice and baseline for a lot of operations, so that we're efficient, consistent, and that makes sure that compliance happens appropriately and reduces the amount of noise for our associates who are trying to do the right thing and follow the right processes.
Yeah,
I concur.
Right. Great, thank you. So
just if I could just jump in, one thing Naseem mentioned on FAQs, just keep in mind that the staff has started to publish FAQs on 285. Their first one was on March 1. It really went to an accounting series release 118, but you want to keep monitoring the SEC site. They may come up with other FAQs on this rule. So.
Yeah, great, thank you. That's a great point. Okay, so moving on to the next big rule, the derivatives rule. I'm going to stick with Brian here, and again, for the rules adopted on October 28th. The compliance date is not until August 2022. We've started thinking hard about this. And as well as many of our clients have, there are a number of questions that are starting to percolate. But before we talk about some of those, Brian, there are a number of key differences between the proposing release and the adoption release. Would you mind commenting on a few of those and some of the ones you thought were most important?
Yeah, I'm glad to do that, and I'll highlight a few, and then in the discussion, if others, if other areas are interesting, we can explore those as well. So one of the key changes from the proposal to the adoption was an increase in the levels of the VAR tests that the rule includes. So for some context, both the proposal and the final rule include tests based on value at risk, or VAR, as a means of limiting fund leverage risk. And the role that limitation plays in the overall rules framework is complementary with another requirement for the fund to have a risk management program, a derivatives risk management program tailored to the fund. So the idea is that the fund would set, among other things, would set its own risk guidelines tailored to that fund's portfolio, which disclose risks, what it does, while having this commission set outer limitation. So in a sense, I mean, part of the premise was, funds would be putting in place what made sense, while also having this rule-based outer limit to avoid sort of excessive leverage risk that was not consistent with the limitations in Section 18. At proposal, the VAR of a fund's portfolio couldn't exceed either 150% of a reference index, or for funds that weren't using a reference index, 15% of net asset value. That generated quite a bit of comments. The operation of these tests and among other things, including the levels of the tests. This is a very technical area, so just speaking, to summarize a lot of technical points in hopefully a succinct way, I think the tenor of the comments was that at these levels, the test could have the effect of limiting risks arising from things like security selection and things that weren't necessarily the leverage risk the commission was aiming at, and might also, be sort of suboptimal, at least from commenters' perspective, at serving that outer limit, instead operating more of a day-to-day constraint versus the risk management program that the commission had put in place as well. based on those things and others, the commission did ultimately increase the those limits a little bit. So in the final rule, the relative VAR test is set at 200%, and the absolute VAR at 20%. There's some other details as well, but those are the general rules of the road. That also aligns with the requirements that apply to UCITS funds. So there may be a degree of compliance efficiencies for managers that themselves manage UCITS or have affiliates that do. There also were some other changes around the operation of the VAR tests that I think in general just make them a little bit more flexible in practice. For example, at proposal, if a fund was out of the VAR out of compliance for a period of time, the fund could not enter into any derivatives transactions other than those designed to reduce VAR. And the commission made some modifications to those types of requirements to just provide a bit more flexibility while still requiring funds to come back into compliance promptly. And I'll tick through three, and then I'll pause. Another area, a change from proposal to adoption, was related to the framework to be a limited derivatives user. I mentioned this in part to highlight the role that this plays in this rule. So under the final rule, to be a limited derivatives user, the fund's derivatives exposure, which generally is gross notional amounts with certain adjustments, cannot exceed 10% of NAV, and certain currency and interest rate hedging transactions are excluded from that 10% calculation. So the fund can hedge those risks and also have 10% of non-hedging derivatives. I focus on this one because the implications of being a limited derivatives user are that that fund does not need to comply with the VAR test that I just mentioned, or to put in place a formalized derivatives risk management program. So really the goal here, the commission's goal, was to scale the stringency of these requirements to the level of the activity that we're talking about. And the commission's estimate is that about 80% of funds will qualify as limited derivatives users, based on analysis that we did and also based on some survey information that we received in the comment process. The change from proposal to adoption is that in the proposal, a fund had a different sort of choice. It was either hedge solely currency risks or 10% in derivatives exposure, but no ability to combine those two. And so the final will provide some flexibility by essentially combining those two elements, allowing certain interest rate hedging transactions as well, and then providing some other provisions that both clarify and I think provide a degree of flexibility for a fund that temporarily goes beyond that 10% limit without having to immediately put in place a program or take other actions. The final change that I have teed up, and one that I thought might be of some interest to this audience, is the commission. Probably the most controversial aspect of the proposal were a pair of sales practice rules that would have required broker-dealers and investment advisors to approve a customer or client's account to trade in leveraged and inverse funds before the customer were to be in that trading activity. These provisions were modeled after FINRA rules that apply to options. Likewise, under those rules, before a broker-dealer customer trades options, whether recommended or not, there's a due diligence process the broker undertakes and an approval requirement. These proved, quite controversial, and ultimately the commission determined, in light of the other changes to the rule, not to adopt these sales practice rules. So the commission did not do that. The commission did, however, direct the staff to begin a review of complex investment products, including leveraged inverse funds, and that is a joint effort among various divisions of the commission, including IM, trading markets, and corporation finance. There's certain other changes that I could mention, but in the interest of time, I'll pause there.
Yeah, thank you. So I think just given the topics, we're going to keep moving. But you mentioned that I think you mentioned 80% of funds would probably fall under the limited derivatives user exception. I have no doubt that that's true, but it's interesting because those funds. I think a more interesting question, at least for us, is how many fund complexes as a whole would probably would have all of their funds fall under that. Because as you know, if you have one fund that doesn't qualify, then you're going to need to adopt a program and really incur that expense regardless. So that that's one of the questions that we are considering. And related to that is, and I think it's a question, Naseem, you brought up at one point, which I think is a really interesting one. Do you have conversations with sub-advisors that have a strategy that potentially may be put you over that 10% threshold and talk to them about whether they want to modify their strategy. So that's, I think there's going to be some interesting discussions around that point. Other types of questions that we've been getting on the derivatives rule at this point. Could an investment advisor be responsible for remediation costs or losses associated with an investment that causes a fund's VAR threshold to be exceeded? We're thinking through that, but I think our general view is probably not under the rule. Although you just want to make that clear in your policies and discussions with the board about how the rule functions. Other types of concepts we're thinking about, the intersection of the liquidity rule and the derivatives rule is a very important one. When you get close to that VAR threshold, does that impede your ability to draw on a credit facility, for example? Another question that I do a lot of close-end fund work, and I think this is more relevant in that space. But I think the question of how you treat reverse repos and having that flexibility under the rule to treat them as loans under Section 18 rather than derivatives is very interesting, and I think there's going to be a lot of discussion around that. So with that, moving on from the derivatives rule, we'll turn to fund of funds. And here I'm going to turn it right over to Chris. I think an important question here is that the fund of funds rule does away with participation agreements, and it's going to rescind much of the ETF exemptive relief out there that folks rely on to invest beyond the limits of 12D1. Do you want to talk about how you see practice changing going forward in light of that?
Yeah, happy to do that. Just a brief recap for the audience. From about 2000 onward, the number of exemptive orders for ETFs was a little over maybe 300, and really since the mid 90s, those ETF orders pretty much had in common certain conditions when it allowed funds such as our open-end investment companies that wanted to invest in ETFs and wanted to invest at greater levels than would be allowed under 12D1A and B for the acquired fund. And one of the requirements of the three principal requirements was that you enter into a participation agreement. And so, as Nathan indicated, with the new 12D1-4 rule, fund of funds rule coming into play, participation agreements are going to be gone. And so, in its place, there is going to be essentially a fund of funds investment agreement between the acquiring and the acquired funds, which must be executed unless the funds have the same advisor. But and this agreement must include at least about three main items: any material terms necessary for each advisor to make the appropriate finding that is required under the rule, a termination provision, and then a requirement that the acquired fund provide fee and expense information to the acquiring fund. So what's the issue right now? Well, right now, I would purport that we're in a no man's land. If you go to the ETF sponsors and you say, look, I've got in place with your firm a participation agreement. What's the thinking about what you're going to do in terms of a fund-to-fund agreement under the new rule? And essentially, all of the key sponsors that we've gone to, and they're the large players in the industry, they say they're taking it under advisement and they're looking at this. Here's the other issue. Participation agreements had become pretty much standard throughout the industry. We knew what they were. We negotiated the terms. We paid attention. We gave our advance notice, et cetera. Now we're going to bespoke agreements. And so, the SEC intends for the fund of funds investment agreement to memorialize the material terms negotiated between the acquiring and the acquired funds and include tailored terms specific to that arrangement. Unfortunately, the more bespoke nature of the agreement envisioned by the new rule, 12D14, will likely impose additional costs on funds as participation agreements, as I noted, have become more uniform. And in addition, what one advisor considers necessary to making findings, another one may not. Under such circumstances, the fund with less market power may be forced to reconsider its need for the information. The pressure is going to be on the acquired funds, often ETFs, because they're anxious for a substantial investment from acquiring funds. But if you have mutual funds that currently rely on the ability to invest in ETFs, this is something that you want to get on, you want to stay on, and you want to buckle down, because if you have portfolio managers coming to you and saying, excuse me, what are you going to do, or what are we going to do if we can't invest in these? That's a real dilemma and problem. Let me stop there, and Nathan, go back to you.
Yeah, really great points. I think on the investment agreement, we've actually been working with, as you know, working with a few trade associations on coming up with a draft form of fund of funds investment agreement. I think the general input from industry participants and in our drafting is that keeping it a streamlined agreement and just focusing on kind of the strict requirements of the rule, that key point about what you need in there for an acquired fund to make the findings, that kind of there's not an undue influence on the acquired fund. So that's still in process, and there are a few key points being considered, but hopefully soon we'll have a form that can kind of be circulated well, it is currently being shot at by many industry participants, and hopefully that will continue, and we'll have a good form. Naseem, how do you think the fund of funds rule is going to affect current structures that folks have in place?
Sure. Yeah, I do think, kudos, I think, to the staff of the SEC for, tackling some of the tough job of consolidating decades of exemptive relief and layered applications of Section 12D rules into a single rule. So I do think it's helping level the playing field on that front. However, I do think there are areas that the final rule did not address that are still on the minds of fund sponsors who are looking to fund structures that protect investors and provide cost savings and other efficiencies that benefit our investors. For example, there are opportunities to have, or I guess a question more is, are there opportunities to have 3-tier no-fee central funds within a complex that exceed the rule's 10% limit with appropriate safeguards? I think managers are always looking for opportunities for efficiencies in our investment and our trading and our operational processes, like the ability to trade and settle in fewer and larger blocks, which may also result in better execution through fund-to-fund arrangements, which again benefit our shareholders. And so at the same time, these arrangements give funds access to a more broadly diversified set of securities and a specific asset class when you can have these arrangements. So I think there's kind of that ongoing questions of trying to look for efficiencies and wondering, are there opportunities for testing these areas, even though a final rule has now been put into place.
Yeah. So Brian, what do you think? Do you think there's any potential relief in this space? Any questions that the staff is receiving, but any potential for relief around existing structures?
Yeah, I'll offer my perspective here. I think in a rule like this, where the commission has, taken a body of orders and brought those down, grapple with certain questions, and put in place a rule of the road, I do think there would be a reticence to take up the same issues that the commission just addressed, one way or the other, in the rulemaking and exemptive application process. But by the same token, where there are issues that weren't addressed in the rulemaking, I do think those certainly can be fairly raised. Just to give you 2 examples of things the commission said, one, as sort of more of a general matter, the commission observed in the final rule release that one of the benefits of the rule is that it would allow the commission, as well as funds and advisors, to focus exemptive order resources on novel products or arrangements. Naseem, more specifically to the multi-tier question, the commission also did mention that it would be more appropriate for the commission to consider multi-tier structures. They're not within the scope of the new rule in the application process. So I think putting that together, I think what you're seeing is the commission saying, look, these are the general parameters. It's not to say that's the final word. I think an analogy I'll offer is the ETFs context. So you see Rule 6011, the commission acts, looks at a bunch of orders, puts in place sort of a rules of the road, for lack of a better term, sort of a plain vanilla ETF structure, while also looking to sort of level the playing field there. But at the same time, being willing to consider and also grant orders for non-transparent ETFs and other structures. So, long story short, I think the commission's effort is to level the playing field, have a single rule that can govern, at least what will become plain vanilla fund-of-fund structures. But I don't think that's the last word on whether there can be other areas explored in the applications context.
Yeah. Very interesting. Thank you. Yeah, it's going to be interesting. At this point, as of January 19th, we can start relying on the rule, and January 19th, 2022 is when the various exemptive relief and Rule 12D1-2 will be rescinded. So I think we'll see a lot more thinking about this over the next year. So Chris, I'm going to very briefly, just in the interest of time, closed-end fund offering reform, a major development for a smaller portion of the registered fund community, but that took effect in August of 2020. From your perspective, how have you seen it play out so far?
Yeah, well, first of all, I think the SEC did an absolutely cosmic job on this. The SEC essentially leveled the playing field with respect to certain closed-end funds and public reporting companies. They came up with this concept of a seasoned fund that's a fund that has a float of about 75 million or greater. And then it came up with the well-known seasoned issuer definition. That's a float of 700 million or more. And so for those of you with closed-end investment companies that are active in the at-the-market 415 shelf offering space, this rule is terrific. What it does, so for seasoned funds, yeah, you'll have to file a Form N2, but it's a shortened Form N2, and you have to go through staff comment, and the staff has to deem the registration statement effective. But once it does that, for the life of the shelf, you're pretty much done and dusted in terms of the registration statement. You don't have to worry about doing annual updates to that registration statement. There are a whole host of additional benefits that come along with that, but I'll try to keep my remarks very short. It gets even better if you're a well-known seasoned issuer. There, you've got to do your registration statement, but you got to do everything that you would typically do between the time when you file an initial N2 and you get the staff comments. You got to do all that up front. Well, why do you have to do that? Well, because once you file that N2, you become immediately effective. Now that's great. And that might be able to shave off up to 30 days off the process, soup to nuts, to get a shelf offering in place. And then once you've got it in place, you can do the forward and backward incorporation by reference, something that's also contemplated with seasoned funds. But there is no need to apply for no action relief from the SEC with respect to being able to submit annual registration statement updates, et cetera. So it saves a lot of time. So from my perspective, the SEC hit a home run here.
So I completely agree. I do a lot of work in this space and have been thinking about it in quite some detail over the last 6 months. I think it's a great development for the closed-end fund space. There are some initial things that we've been having to work through, but frankly, I think many of us have worked through it, and now that we've gotten over it, it's a great opportunity for closed-end funds to be able to raise assets like, frankly, they haven't been able to before. So it's great.
Yeah, so, and it cuts costs, and the business loves that. So no offense to the folks in the outside counsel space, but once you get through the initial registration statement, you can pare back a lot of costs that the funds had to bear to put pressure on raising assets at these at-the-market offerings. That's another great benefit from, the SEC did us a big favor there. Just saying.
Well, no offense taken, although we will have to take a little bit more closer look at those shareholder reports now. So we'll
Yeah.
we'll continue
Because you
looking at
got
the
to
disclosure.
Yeah. All right.
All right, so that wraps up our. Those are the major developments we've seen in 2020 around registered funds. Moving on to what we're kind of dealing with in the future. The first item that we're going to touch on is the new disclosure framework proposal. And given the timing, I think we're going to combine this discussion along with just a general discussion on current disclosure practices. So why don't we, and for just a very, very quickly, this was a proposal put forth by the SEC to, really revolutionize open-end fund disclosure framework. It will have major, it will change the way we think about disclosure. Generally, I think probably it's a good step forward, although there's a lot to work through, and we'll see what the adopt and release in the final rule, if we see that, looks like. So Naseem, what are some of the key points that you think, kind of thinking about in this proposal?
Sure. Yeah. And I really do commend the SEC staff for seeking ways to improve the investors' experience with fund disclosures. We think the SEC could inch closer to modernizing the framework even more than what the proposal outlines. And that's why I think I just wanted to highlight today. One topic is the electronic experience continues to be an issue. Under the proposal, open-end funds that use streamlined shareholder reports would have to mail them to all shareholders unless a shareholder affirmatively elects electronic delivery. And we strongly urge the SEC to adopt an access equals delivery approach for the delivery of both shareholder reports and the annual prospectus updates. From our perspective, the pandemic has really showed us how effective electronic communications can be and how they are the way of the future. And we think this approach, not only saves paper resources, but it also saves shareholders money. At Capital Group, we estimated that in 2020, the total annual printing and mailing costs for all of our fund shareholder reports and prospectus updates was over $48 million. And this is $48 million that could be put to better work towards shareholders' investment goals. So that's one area, is that relationship between Rule 30e-3 and this proposal. And another challenge for us is how under the proposal, funds wouldn't be able to incorporate information by reference into annual reports. We definitely support a framework where shareholder reports are concise and engaging for our investors. But I think if funds are unable to incorporate by reference, they'll be vulnerable to increased litigation from the criticism that they have hidden or improperly excluded information from the streamlined report. So I think there's just some tensions there, and we've commented on this, and I think others have, and it'll be interesting to see how the engagement process continues over this next year in being able to help this report or this proposal, I think, be a really effective rule and communication tool for investors for decades to come.
Yeah, so you mentioned comments. I guess on that note, Brian, what have you started getting? I'm sure you've started getting comments. What kind of comments are you seeing? What's worth highlighting?
Yeah, so we're definitely in the process of going through those now. I'll highlight a few, and with an effort to tick back some of the points that Naseem made, and maybe flag one for Chris to comment on as well. So just a few themes. One, I would say, generally speaking, I have a certain bias in saying this, but I think fairly favorable comments in terms of the streamlined shareholder report, representing an improvement relative to the current experience. As did any proposal, a number of more specific suggestions around that, but I think generally speaking that was favorably received directionally. To speak to 30E3, Naseem, you mentioned that one. Definitely there was, I think a certain number of comments urging the Commission to retain Rule 30E3, although some commenters also supporting the Commission's proposal to to limit the application of that rule. Just to speak to that, if it's interesting to folks, and this is not at all to suggest that we're not reviewing the comments open mind, because we certainly are, but just to give a perspective at the proposal stage, I think that the idea is that under Rule 30E3, an investor is mailed a short document that identifies for the investor, where to go to find the shareholder report online. Another aspect of this most recent proposal is that an ability for a fund not to send the annual prospectus update to existing investors in lieu of updates and material changes, and the expectation the investor has access to that streamlined shareholder report. I just think one question that we were grappling with as policymakers is, if you put all that together, the only disclosure that an investor receives every year directly is a notice to go online. And I guess that just raises the question, under this new framework, is that the best? Is it going to be one mailing a year, one short mailing a year? Should it be that one, or should it be this new streamlined shareholder report the commission is putting together? So that was the thinking, but we definitely are getting a lot of comments in that area. We definitely did get a lot of comments also on electronic delivery, as you mentioned, Naseem, and as well as I'll just broadly categorize as liability concerns about to the extent to which funds in different contexts are asked to speak more narrowly about a thing, or there's questions raised about related topics that were not mentioned in that communication. You're definitely examining all of those things. Certainly was not the intention of the rulemaking team to create liability. I think we were trying to just focus investors on information that we thought was most salient and avoid information overload. And I definitely could tick on several more. I guess I'll just mention one more, and maybe Chris, I can ask for what your thoughts might be in grappling with this issue. Is one of the changes that was proposed was to require principal risks to be ordered in relative importance. The commission observed, and the staff previously had in the review process observed, that some funds alphabetize those risks or otherwise present them in ways that aren't maybe not tailored to the fund, or certainly not sort of indicate in any order of particular importance. And maybe I'll just give you what sort of was the rulemaking team's perspective, and then Chris, maybe for your reactions in terms of the operational challenges, which we are hearing about in the comment process. But basically, it was just that this disclosure is designed to communicate to an investor, the investor investing in one fund, not all funds in a trust, or what are the risks of that fund. And I think the concern was that those risks, especially they were sort of more voluminous, something that can feel incrementally somewhat generic. If they were just sort of alphabetized, an investor might just not take away from that. What are the most salient risks here? What's the real takeaway here? So the thinking was that having funds order those in relative importance would more effectively communicate the risk information.
Yeah, I'm happy to comment, and never lost for a thing to say here, but I go back, right? On September 9, 2019, the SEC's Division of Investment Management, released an accounting and disclosure information, or ADI, entitled Improving Principal Risk Disclosure. So this has been something top of mind for the SEC for a bit of time, and even before this. It is not unusual when you're filing a registration statement with the commission to get back in a comment the fact that they want you to prioritize the risks in order of priority and not alphabetize them. We always try to push back on something like that and keep them alphabetized. Why? Well, when you go real life to portfolio managers and analysts and you're asking them to prioritize these risks, they give you one of those looks like, well, wait a second. Today it's COVID-19 global pandemic. Yesterday it was Brexit. Then the day before yesterday it was LIBOR. And then, whatever else that we've got, the tech bubble, the financial crisis, whatever. And so what we're trying to do is make sure that we've got all of these, risks accounted for. But when you're asking us to put these in priority, Jackson, you got to be kidding. So we understand, and the staff understands, that ordering risk based on importance requires some subjective determinations, and we get that. With respect to annual reports for closed-end funds, we ended up having to, do just that. We prioritize risks. But sometimes what happens is let's say across your fund group, you've got 22 risks in this particular fund, you've got 31 risks in this fund, there's a tendency to want to include and go to the lowest common denominator, include all the risks, and then you want to try to be somewhat consistent, although this is supposed to be a fund by fund analysis, right? So you won't have the same ordering, but then you want to be careful that you put in some type of lead-in paragraph that says, wait a second, this is our ordering of risks today, but please keep in mind, investor, that these things are subject to change. And so it comes back to us to sit there and say, okay, well, we've got to make this valuation on a periodic basis. So that's a little tougher. It was easier when we could alphabetize.
Sorry, Nathan.
No, please, Brian, go ahead.
Oh no, that was it. I was just going to say, some of that's definitely more color and flavor, but those type of points are also being stressed in the comments on this.
Yeah. The only thing I will add to this is we see we get a lot of questions from clients on this, and what I will say is practice is completely mixed. And from our perspective, clients go one way, clients go the other way. From our perspective, as long as the disclosure is in there, we feel pretty comfortable with whatever the firm would like to, whatever the advisor would like to do, for at least from a liability perspective. So, but it's absolutely an interesting question. So moving on, we have a number. We have, I would say, three bigger topics we want to cover here in a few minutes. I think what I'll do is, Naseem, Brian, we'll talk about the digital assets and ESG together, and then maybe I'll just look to you and see if there's anything you can say about either one of those, and from your perspective. So Naseem, this is just more of an interesting topic than anything. Clearly, there's a lot of interest, and it's increasing week by week in digital assets. Related to investment, risk, regulatory issues, custody. Just what are some of the things that you're finding most interesting about this topic?
Yeah, I was thinking just a couple weeks ago, at the end of last month, I had read an article about how with Bitcoin's value hitting a record high, how Tesla's Bitcoin holdings had risen to, I think, like over $1 billion in February, more than it had earned from profits in selling actual electronic vehicles. And so it's that idea that this growing and potentially growing trend of operating companies obtaining significant exposure to digital assets and allowing customers to transact in those assets, I find really interesting. How will that impact us as fund sponsors who may, in my view, indirectly gain exposure to digital assets from investing in operating companies? I think that's one of those emerging topics that I find kind of interesting. And it's been a while since I think the SEC has engaged, or at least Division of Investment Management is kind of engaged on fund investments in cryptocurrencies, and there has been percolating changes, but this new development just made me think, this issue isn't going away, and so it'll be interesting how we modernize and develop with this new kind of area. And I also continue to wonder about the growing pressure for federal securities laws in this space as state regulators like Wyoming and South Dakota move forward with permitting custodial services for digital assets. So I just think it's a constantly, like you said, evolving kind of week by week area, but it's one that I think is not going to go away, and so we're all needing to think about it and engage.
Yeah, it's fascinating. I mean, we have clients who say we're not touching it. Other clients can't wait to start thinking about it. The ones who aren't touching it, a couple weeks later, they start to get more interested. So it's definitely not going away. Actually, Brian, I'll just pause there. Is there anything you can comment on around digital assets?
I don't think I have a lot to add. I mean, I guess I will say my upshot is I likewise see this as an issue that will continue to be part of the conversation. I mean, IM has sort of solicited input on different custodial issues raised here. It has been a few times since there's been that dialogue with fund sponsors. I mean, maybe the only thing I'll add is, for anybody who's watching Gary Gensler's confirmation hearing, I know I was watching that hearing, and definitely you saw a lot of exchanges on crypto digital assets. So you see interest in Congress. Obviously, Gary Gensler brings a level of expertise in this area. So, I given all different stakeholders having a high interest here, I expect this to be part of the dialogue going forward.
Yeah,
Yep,
and
absolutely.
Nathan, just to
Please.
say it, the Division of Examinations did just issue a risk alert in this area. So if you're going to engage with crypto currencies, make sure you take a look at that and get a game plan, both at the advisor level and the fund level.
Yeah,
Good point.
thank you. Thank you for noting that. Yeah. Okay, turning to ESG. You can't have a trending topics panel without that. Brian, let's start with you. This is obviously industry is extremely interested in this. Anything you can say about ESG?
Well, I guess what I can say is I think this also is top of mind for many. I mean, and there's been a slew of sort of public announcements from the SEC about ESG related issues. I mean, just yesterday, the commission announced the creation of a climate ESG task force in the Division of Enforcement. Earlier this week, examinations as part of its 2021 priorities, also mentioned as prioritizing climate and ESG. Last week, Acting Chair Lee directed Division of Corporation Finance to focus on climate-related disclosures and public company filings, and also to begin updating 2010 Commission guidance regarding climate risk. And that's just sort of just over the last 2 weeks or so. And so I definitely this seems like it's top of mind for fund sponsors, for investors. Obviously from these public statements you can see that it's on the mind of many of the commission. So with apologies that I can't offer more direction than stay tuned, I think I can sort of point to these and say this is an area of interest.
Yeah, not surprising to hear. Naseem, are there any particular challenges that you're thinking about and your firm is thinking about in the ESG context?
Yeah, I think one of the challenges for us as an active shop, is ESG related disclosures by corporate issuers are made largely on a voluntary basis. So, there can be a lack of consistency and quality and comparability of ESG data, which can yield kind of limited value to investors. We work hard and engage with folks, but for those that don't have the resources to do so, I can see where, this is an area ripe for regulation and modernization. I just hope that with the new agenda of the SEC and like Brian mentioned, the different task force and enforcement, the OC priorities, and new personnel at the SEC that are targeted and focused on this area, that things can be done in a sequence that the industry really can be engaged in the process, and that rules are contemplated through engagement, and in my view, hopefully not through just enforcement, but that we really do have a conversation, a dialogue, and I think that is the intent. I think another challenge for creating a framework is creating a set of common standards that would be flexible and not overly prescriptive, so that they're able to apply to new ESG issues as well as market and technology developments. So we're looking forward to engaging with the SEC on this, and have had some experience with the EU and its sustainable finance disclosure regulation framework that goes into effect this month. So another challenge is for those that have global offerings, being able to have some consistencies across borders, and try to have some operational efficiencies. So it's both the sequence. As an investment manager, it's helpful to start with the corporate information that we rely on and build a asset management framework on that, and then having some consistencies across borders to the extent we can.
Yeah, that's very complex area. That's for sure, and not a lot of consensus, which makes it even more complicated. So, please, sorry, Chris, did you have something to add?
No, I'm good.
Oh, okay. All right. So we have just a few minutes left. I wanted just to quickly, because it's so important, just touch on closed-end fund activism. I will just say, without going into much detail here, obviously it's an incredibly active, no pun intended, area right now in the closed-end fund space, both on the activist side and on the fund sponsor side and the fund side and the board side. So there's a really, and for good reason, this is really an existential question I think for both the activists and also the closed-end fund industry. And Chris, I know you have strong views on this, so would you mind sharing them?
No, I don't mind sharing them. There are 3 points I want to make, but in the interest of time, I may not get to all of them. But number one, activist activity rose dramatically in 2020. The number of campaigns jumped from 29 in 2019 to 38 in 2020. And the number of proxy contests went from 23 in 2019 to 29 in 2020. Why? There was a big market dislocation resulting from COVID-19. It widened spreads between the closed-end funds NAV and their trading prices, and discounts widened. This is like blood in the water for activists. Activists' number one objective is to monetize that discount. Point two, the tactics employed by activists include seeking seats on the closed-end funds board and replacing investment advisory firms. In proxy contests, though, you do not often see a change in the board composition or a change in the overall governance, but in virtually all of these contests, you do see where the closed-end fund commits to some monetary event, a self-tender offer, or some percentage of NAV in exchange for which the closed-end fund receives a standstill agreement. Point three, what can a closed-end fund do to help protect itself? There's 4 levels of activity you should consider. Level 1 is governance. Work with specialized counsel like Ropes and Gray to review and seek to amend charter and bylaws to make the playing field more level. Level 2, give consideration to engaging in open market buybacks, periodic tender offers, and manage distribution policy depending on your closed-end fund and level of discounts and pervasiveness. Level 3, work with your trade groups such as the ICI to innovate them to take up with the SEC and with Congress this issue. These are concerns. And level 4, congressional action. Last year, November 19, 2020, Congressman Gonzalez of Ohio introduced in the second session of the 116th Congress House Bill HR 8786 to amend the Investment Company Act of 1940. The bill was Increasing Investor Opportunities Act, and it would include in sections 3C1 and 3C7 a reference to section 12D1C, so that private funds would be limited to 10% investments in closed-end funds. That proposed bill would have to be reintroduced. If you want closed-end funds, if the SEC believes closed-end funds are viable for the marketplace, retiree investors, we got to stand up and confront this grave concern. That's my view.
Thank you very much, Chris. And Brian, I won't even ask you to comment on this topic because I know it's I know it's a tough issue for the staff, and but I also know that have been great engaging with the industry on this topic. That said, we are out of time. We're a few minutes over, so I just want to thank all 3 of you for doing this panel, and thank the audience for attending. I apologize for it being such a whirlwind of topics, and I can assure you we left a number of topics out. So hopefully next year it'll be a little bit more manageable. But thank you all, and I hope to see you all soon.